video, I want to talk to you about the debt service reserve account. In any typical project finance deal, a number of accounts needs to be established prior to financial close, and that is because lenders, they want to monitor the cash flow that is going in and out of the project of the SPV. And that is because in a project finance deal, basically the projected cash flows are the only means of repaying the debt. So lenders are very careful and they want to monitor the cash, every single penny that goes in and out of the cash flow. And because there are no other securities than the projected cash flows and there are a lot of uncertainty attached to these projections, one way to kind of secure liquidity is to establish what we call a debt service reserve account. So that's one of the requirements of lenders in a project finance deal. And today we're going to discuss about the issues related to the debt service reserve account when it comes to term sheet negotiation and the modeling behind it. Okay, so the first question to ask is whether the lenders that you are considering for your project are requiring the debt service reserve account. So that's the main question. Most of the time in any typical project finance deal, lenders do require some sort of kind of account, they call it debt service reserve account, or they might come under different names, but usually they do require. So, that's something that you need to discuss with the lenders. For example, if it is a mezzanine loan, they might not require a debt service reserve account. So if you are at a stage where you're still negotiating or considering, you didn't approach the banks yet, so that's something that in your financial models you might want to consider a switch where you basically look at the case where the lenders do require or do not require a debt service reserve account to be included as part of the accounts that they require. Okay, so the next question is how this reserve account is going to be funded. Who's going to put the money for this reserve account? So there are multiple ways to fund the debt service reserve account. Typically, lenders require a pre-funding of the debt service reserve account. This means that as part of your project cost, during the construction phase, you just gonna fund all the costs, like the cost that you're gonna pay, the payment to your contractors, if you're paying an insurance, SPV cost, and everything else is gonna be funded with debt and equity because you still didn't start, the operation of the project has not yet started, so you don't have any revenues, so it's going to be funded with debt and equity. So when you're sizing the debt, this pre-funding of the debt service reserve account is going to be included in the sizing of your debt. So that's something that you need to consider in your sources and uses of funds during construction. However, lenders, because as you know, this is a cash which is gonna sit in an account and is gonna, if you're gonna fund it, at the beginning of the construction, is gonna bear interest throughout the construction. So for example, if you consider a hydro project which takes like 2, 3, up to 5 years of construction, so having an idle cash sitting there and you're accumulating interest on that is not very productive. So most of the time, lenders allow you to establish that debt service reserve account in the last construction period. So just before COD, commercial operations date, they want you to have that account established and has a certain amount of fund that they require equal to certain amount of interest and principal of the loan to be included in that debt service reserve account. That's one way, we call it pre-funding of the debt service reserve account. Another way that you might want to consider and lenders might allow you is to have a letter of credit for this debt service reserve account. So it's basically backed up by an LC. That's also an option that you can discuss with the lenders and ask them if they are okay with that. If that's the case, there is a cost to an LC, right? So there is, it depends, but it's normally 2 to 3% that you need to consider as a fee for this LC. And the next question is that who's going to pay for the LC cost? Most of the time they allow you to put it as a budget, as the cost, as part of the SPV cost. And it's going to fall in the cash flow waterfall of the SPV, so it can be paid by the SPV. But that's something that also you need to discuss with the lenders of who's going to pay the LC fee and where it's going to be paid in the cash flow waterfall. Okay, the next question is, if the lenders require you to pre-fund the debt service reserve account, then by how much? Okay, so there are different possibilities. They might ask you to fund it. That's very typically that's what it's a requirement that they fund it up to the first principal and interest repayment. So for example, if the debt is to be repaid on semi-annual basis, you're going to have to look at your debt service repayment profile and take the first one and fund and size the debt service reserve account that is going to be pre-funded up to the first 6 months of interest plus principal. That's one option. Another option that you might want to consider is to take the maximum of debt service throughout the life of the loan and then pre-fund that as part of your project cost. Because that's usually required when you have like a sculpting of debt. So most probably at the beginning you don't pay much, and then towards the end you pay more. So what you do is that you take the maximum of your periodic debt service and fund the maximum in the last construction period. Another option will be that the lenders might allow you to partially fund the debt service reserve account. So for example, if the first debt service, just as an example, let's say that you finish your construction and 6 months after you need to repay the debt, and the debt service that is required at that time in the first repayment period, let's say is 5 million euros. However, in terms of the pre-funding, the lenders might tell you that, okay, we are going to pre-fund 2.5 million, and the other 2.5 million, you can fund it from cash from operation in the first operational period. That's an option that you might want to consider. However, the typical one is to fund it up to 6 months, 3 months, depending on how you pay your debt of that service. Now, the next question is, what is the DSRA requirements throughout the life of the loan? So what should be the ending balance of this reserve account in each model period or in each repayment period? Typically, lenders require the debt service reserve account to be funded up to the next upcoming debt service. So, for example, at the end of each period, lenders will monitor that account and make sure that there are enough funds to pay for the next upcoming debt service. And that's one of the covenants that the lenders will monitor throughout the debt repayment, and is one of the covenants as well for the dividend distribution. So this debt service reserve account needs to be fully funded. And if not, then the distribution will lock the dividends, right? So that's all the things that, when we are discussing, you need to think about it, that you also need to reflect all these flexibilities in your financial model as well. I have seen cases that, for example, lenders, there was a semi-annual debt repayment. However, because of the risk related to the project, they required not only 6 months, but 12 months looking forward of debt service to be funded, to be available in the debt service reserve account. So as you can see, that's also another flexibility that you need to consider in your financial model to allow for 6 months or 12 months of debt service to be funded in each model period. Another important question to ask is whether lenders allow any release from the debt service reserve account throughout the life of the loan. There might be cases that the lenders, for example, in the case where we talked about the pre-funding of the debt service reserve account, remember we said one option is to fund the debt service up to the maximum of periodic debt service. So they say, okay, we're going to fund it up to the maximum, pre-funded up to the maximum of that service, and then we're going to lock that money and make sure that that money is available, so that in case we have any problems in each model period, there are enough funds in the reserve account to kind of solve the problem that we have in that period. So the maximum is there and it is locked. So if there are any excess cash, you're not allowed to tap into the reserve account. You need to lock it. So it's kind of like a chunk of money sitting in an account. And if there are no problems, basically it's just the money sitting in the cash and it's not being used in case there are problems in future. So that's something that needs to be discussed during the negotiation with lenders, that whether they allow any cash to be released from the debt service reserve account. So if they allow you, then you will have to model that in the financial model. You will have to check for the excess cash. If there are any excess cash, you can release it and of course distribute it as dividends. And if there are any shortfall, then you need to fund it from the cash flow. So all that movement in the cash flow in the debt service reserve account, inflows and outflows, needs to be modeled. And if it is locked, then you're going to lock it. So the money is going to be funded up front and it's going to be released in the last basically principal or debt repayment. Okay, of course, in cash flow waterfall is one of the most important statements in a project finance deal. I have a template and a manual for the cash flow waterfall. I'm going to put the link down below. If you're interested, you can go and have a look at it. Today, we're going to also discuss about the positioning of this cash flow related to the debt service reserve account in the cash flow waterfall. So that's something also that you need to discuss, needs to be discussed, whether you're a lender or you're a sponsor. Needs to be discussed between the different parties about where does this funding of the debt service reserve account will be in the cash flow waterfall. So let's get into Excel and have a look at a typical cash flow waterfall. So this is the cash flow waterfall for a project that I am showing you here. So we have the revenues, we have OPEX, we get into the net cash flow from operation. Then we have all the other OPEX, major maintenance, working capital, taxes and everything. And then we have the instruments for financing the cost. And then we have the cash flow available for senior debt service. And then we pay the interest and principal, and we also, this is kind of not a typical, but I put the funding of the maintenance reserve account here, and then I am just saying that any cash inflows and outflows comes after I repay the debt. So it's subordinated to the payment of interest and debt service to senior lenders, okay? As I said, these are all subject to discussion between lenders and sponsors, but typically the funding of the debt service reserve account is subordinated to debt service and is superior in the cash flow waterfall in terms of positioning to any mezzanine or junior loan, and of course to any shareholder loan and dividend repayment. So there are things that you can still discuss, and I think is worth discussing with the lender, is about the release from the debt service reserve account. So if there are any excess cash sitting in that account, can you use it to pay the loan, or no, you cannot? You just release it as dividends or pay the junior lenders. So is there any possibility, you need to discuss it, this needs to be discussed, that any release, excess cash from the debt service reserve account, can it be used to repay the loan? So if that's the case, if they allow you that line that you see release from the debt service reserve account, instead of being here, it will come basically before that service, right? It's going to create all sort of circularities in the model. But it's worth it because it's going to help you, especially if you are sizing your debt with the cash flow available for the project, meaning with a target debt service cover ratio rather than a maximum gearing. So these are the things that you need to consider when discussing, the debt service reserve account between lenders and sponsor. So I'm just going to quickly take you to this financial model and show you this is not like Sorry, there's a fly. So for example, all the things that we discussed, previously, I'm going to show you how I modeled it. So for the debt service reserve account in the financing term, this is my input sheet. As you know, I am using a kind of one model approach. So I am presenting my inputs in form of scenarios. In the financing section, basically financing assumption section of my inputs, I have a section just dedicated for the debt service reserve account. So I give the user the option to basically activate or deactivate the debt service reserve account. If the lenders, they say, no, we don't require any debt service reserve account, then you just put this flag to no, and this account will be deactivated. It's just with the 0 and 1, so all the cash inflows and outflows will be 0. Very simple, but it's very flexible so that you can just include or exclude it in the project. The other thing that we discussed was about the pre-funding of that service reserve account, whether it is pre-funded, and if yes, by how much. So for example, here my model was semi-annual. So what I'm saying here is that I want to pre-fund the debt service reserve account up to 6 months of debt service, interest plus principal. So if I put this to 0, this means that I will not have any pre-funding of debt service reserve account, okay? And I can put 3, 4, 5, whatever. So the model is going to consider 4 months, 6 months, 5 months, 12 months of debt service, which will be pre-funded as part of the total project cost. The other thing, as I told you when we discussed it, I said the pre-funding of debt service reserve account is usually done in the last construction period. I have not come across any project as of now with the experience that I have not seen any deal where they require you to set up the account, in the middle or from the start of the construction. It's just not rational, as we said, to kind of accumulate interest on a cash that is going to be used, as a security during the repayment of the loan. So, but however, there might be the case. So I also provide flexibility for when this account is going to be pre-funded, at which point in time. The next parameter that I have in my inputs is, as we discussed it, whether the model authorizes any cash release from the debt service reserve account throughout the life of the loan. So if it is no, this means that the cash is trapped and is going to be released only when we are done repaying the debt. And if it is yes, then it's going to have a movement of inflow and outflow depending on the pre-funding of that service reserve account and depending on the future cash repayments. And of course, if this one is no, this means that the debt service reserve account is backed up by an LC, and the cost of LC of 2% here is going to be included as cost in the cash flow waterfall. Okay, so I have a template for the model, if you want to see all these movements in and out and checking with the cash flow waterfall, all of it. I have a template available in my Eloquence channel. So I'm going to put the link down below. You can go and check it out. I hope you find this video useful. My aim basically is to tell you, is kind of share with you what I know, and also to kind of give you a hint about the importance of financial models when you're negotiating your contract. So as you can see here, having a tool, flexible tool with you when you're negotiating a contract will help you to just get a better deal, because first of all, you will have an argument. You can just show them what will be the impact of pre-funding, not pre-funding, by how much to fund, all of this. You can just see the impact directly on the project metrics like the debt service cover ratios, the IRR, and based on these arguments, you can just go and negotiate a better contract. And that's for both lenders and sponsors and anybody else involved in the project. So I'm intending to continue and just, come up with other subjects related to the financial models and at the same time negotiating contracts. So if you're interested and if you have any suggestions, please let me know. And if not, Just keep on modeling, and I will see you hopefully in my next video. Thank you. Bye. If you want to learn how to build better financial models, check out my online course on financial model spreadsheet design at courses.phoenixmode.com.